Hello, my name is Charlie Moran. I'm a senior analyst here at Value Line, and I'm joined today by two other senior analysts, Alan House and Nate Ekman. Today we're going to provide an update on the economy and stock market. We will then recommend one stock to buy right now and finally answer any questions you may have. Please note that this presentation will be available on our website. That's valueline.com, and on our YouTube channel within the next 48 hours. All previous webinars are also posted. Before I jump into the heart of the presentation, for those joining us for the first time, I want to provide a brief overview of who we are at Value Line. We are a New York headquartered corporation that has been providing investment research for more than 90 years. Our flagship product is the Value Line Investment Survey. This service is a unique source of financial information and is designed to help investors make informed investment decisions that fit their individual goals and levels of risk. The product includes data, information, and analysis on equities that trade on the New York Stock Exchange, the NASDAQ, and the Toronto Exchange. It also includes economic commentary, easy-to-follow model portfolios, stock screens, industry-based analysis, and much more. This service, which is published weekly, is created by Value Line's research department, which is comprised of more than 70 analysts, economists, data experts, and quantitative specialists. One thing I want to stress is that our research is completely unbiased and independent. Unlike many Wall Street brokerage firms, Value Line has no investment banking business with any company, including all the equities under our coverage. Value Line does not execute trades for its subscribers and therefore has no vested interest in whether our subscribers buy, sell, or hold a specific equity. What's more, our staff of professional securities analysts are not permitted to own shares of any company that they cover. If you have any questions about the products or services we offer or our different tiers of subscriptions, that information can be found at valueline.com, or you can call 1-800-VALUE-LINE. Now, let's discuss the economy and the stock market. This content was prepared by Value Line's economic staff. The nation added an estimated 275,000 jobs in February. The tally exceeded both the consensus expectation of 198,000 and the previous month's figure of 229,000. At first blush, the reading looked solid, but it did come with a few caveats. The estimated January tally was revised lower by 124,000, and the accompanying unemployment rate rose from 3.7 to 3.9%. The report also showed a decrease in the pace of average hourly wage growth to 0.1%, a continuation of which may be needed to slow consumer spending enough to make a further dent in inflation. Federal Reserve Chairman Jerome Powell said earlier this month in testimony before Congress that the central bank is close to cutting the federal funds rate. However, yesterday, Mr. Powell's remarks came before the later hotter than expected reading on consumer prices, specifically the Consumer Price Index, CPI, and the core CPI, which excludes the more volatile food and energy components. Both rose 0.4% on a month-to-month basis. On a 12-month basis, the CPI and core CPI increased 3.2% and 3.8% respectively, both exceeding expectations. In addition, yesterday, Chairman Powell seemed to prolong the idea that 3 interest rate cuts are still possible this year, while also stating that inflation continues to gradually move in the right direction. Indeed, the direction of near-term monetary policy may prove to be a balancing act for the central bank. The Federal Reserve wants to avoid cutting rates prematurely and risk seeing inflation reaccelerate. This scenario hurt the U.S. economy in the late 70s, and on the positive side, the continued resiliency of the labor market lowers the odds of a period of stagflation, where persistent high inflation occurs along with elevated unemployment and stagnant demand. Thus, we think the Fed will cut the benchmark short-term interest rate 2 to 3 times this year, with the first reduction possibly coming as early as the June Federal Open Market Committee meeting. The Fed must guard against keeping monetary policy too restrictive and risking creating stress in the economy. Signs point to some fatigue among consumers as credit card delinquencies, which surged more than 50% in 2023, continue to rise. In conclusion, recent commentary from the Federal Reserve suggests that the lead bank will likely pivot on the monetary policy front around mid-year. Given this backdrop and estimates calling for double-digit earnings growth for the S&P 500 companies in 2024, we still recommend an investment portfolio consisting mostly of high-quality stocks. Please refer to the inside back cover of Selection and Opinion for our statistically based asset allocation model's current reading. On that note, Value Line is providing a great deal of information and analysis to help our subscribers. We know that most of our users depend on our weekly stock reports, time-tested ranking systems, and other valuable services. In addition, Value Line provides a great deal of daily content that can help you avoid the pitfalls and profit during this volatile time in the stock market. Every business day, senior members of Value Line's research department review the most actively traded stocks, company press releases, news stories, trade periodicals, and other sources for data and information that may change our view and investment recommendations for specific stocks. When something noteworthy crosses our desk, we immediately publish a supplementary report that outlines the new information and, importantly, what it means for the stock and shareholders. This content is posted throughout the day on our website. Again, that's at valueline.com. I will now show you how to access it. Once signed in, head to the dashboard where I am located here, and this is the main landing page for subscribers. Under the quick links, click on Supplementary Reports. As you can see, the research department has been busy publishing our updated thoughts on the stocks that we track, and we suggest that subscribers visit this page often. Some individual companies incurred a lot of debt or sold stock to improve liquidity over the last few years, especially those dealing with sharply reduced demand for their offerings and supply chain problems, among many other issues. Due to the changing structure of company balance sheets, Value Line has been reviewing and altering our proprietary financial strength grades for the stocks in our coverage universe. These changes are posted each week in our Selection and Opinion newsletter. For those of you that don't know, financial strength along with price stability and other proprietary Value Line measure are the two metrics that are used to calculate a stock's safety rank, a key measure of risk. When considering a new stock to invest in, we strongly suggest that you utilize financial strength and safety in your decision-making process. For more information in regard to our proprietary ranks and ratings, Value Line provides a user guide that can be accessed via the investment education section of our website. Finally, this is a good time to mention that the case for individual stocks is quite strong over broad index funds. And so now we will move into the screener and our one stock to buy right now. Let's move onward. And for this, let's go to the screener. Value Line subscribers have access to 15 preset screens and 50 fields. I should also mention that another 100 or so fields are available, but it requires a higher level of subscription. If this interests you, please call 1-800-VALUE-LINE. Let's go to the steps here. The current economic environment remains uncertain, marked by inflation worries, geopolitical concerns, and the possibility of a recession. Many large, well-known stocks have grabbed headlines lately, but we would like to search for other equities with better long-term potential with average risk profiles. We'll start the screening process by looking at safety and financial strength ranks in the ratings and ranks section. And the first filter we're going to use is a safety rank of 3 or better. There are many risk measures to consider, but today we're going to start by applying our time-tested safety ranks. Safety measures the total risk of a stock and is arranged on an easy-to-understand scale from 1 to 5, with 1 being the most conservative issues. I want to highlight the fact that stocks ranked favorably for safety have in the past held up far better than the broader market during corrections and downturns, and they also meaningfully participate in up markets. For more information, I encourage you to peruse our ranking system guide, which is available free of charge from within the investment education section of our website. We're going to focus on stocks with a safety rank of 3 or better. Again, by applying the first criteria, we've trimmed away our potential candidates down from 5,700 to a little over 2,000. And now we're going to go to the second filter, which is the timeliness rank. And we're also going to choose a 3 or better timeliness rank. The timeliness rank is used to predict the relative 6 to 12-month performance of stocks in the value line universe. And the format is the same as the described above with regard to the safety rank, with 1 being the best and 5 being the worst. And that further narrows our selection down to about 861 matches. The third filter that we will apply is the 5-year EPS growth, which we're going to use a 12% rate, at least 12% over the past 5 years, and this figure is derived from past earnings per share percentage gains over the past half decade. It can be seen in the annual rates box as well when you go to the page typically, and when we use that or apply that, the matches go down to 369. Fourth, we're going to use a filter, the market capitalization of a stock, and we would like to find some names that are a bit below the radar, so to speak. So we're going to focus on mid-cap stocks, and these stocks have market capitalizations that are between 2 and 10 billion. And when we apply this filter, we have reduced our opportunity set modestly, I believe. Oh, no, there it is, 123 stocks. And then the final filter we will apply is the 18-month target price range midpoint, and we're going to shoot for 30% or better. I believe we had, the last time we went to press was 12%, given the rise in the stock market of late. That was the median, was in the low teens, 12 to 13%, and now we want to look over the intermediate term, and that is the 18-month investment horizon. And scrolling up to the company data section, we're focusing on stocks with 30% and above, which is well above the midpoint, again, of the 18-month TPR. And by applying the screen, we have chipped away down to 14 final candidates. And you can make a strong argument for any of our remaining candidates, and investors interested in adding new positions should consider them. However, only one can be today's one stock to buy right now, and after consulting with a number of our senior analysts, we prefer and recommend Acadia Healthcare. And the ticker symbol is ACHC. That is up there at the top. Before I click on Acadia, please note that the screens can be saved and revisited by utilizing the Create Saved Screen button at the top. Okay, Acadia, just looking at it from a more fundamental perspective, if you can get the page up, there's the dashboard again, and the page is up on the upper right. There we go. Acadia Healthcare provides mental health care assistance and treatment and has the most facilities in America and a solid reputation with payers. It had 5% comparable store returns, for lack of a better term, in 2023, and said that returns may be a little slower in the first quarter, but that is already in their guidance. Apparently, there was a little bit of a slowdown in the release of state funds for opiate use. There was $56 million billion dollars in settlement dollars in recent years, so that amount of funding should find its way from state coffers, but the timing and the disbursement is in question. I don't think that we have made any assumptions or concrete assumptions on the release of funds anytime soon. Longer term, it looks to add about 300 beds each and every year, especially this year, where it has a pretty clear runway, and that is the case again annually. And only 10% of the estimated 10 million Americans addicted to opioid use have some kind of care at this point in time. There appears a growing acceptance of mental health treatment more and more across the United States associated with drug abuse, generally speaking, from a health insurance perspective. And I think that will, in general, promote a tailwind for Acadia Healthcare going forward. Earnings are expected to be about $3.55 in 2024, and they have exceeded Wall Street expectations over the past 4 quarters. Valuation premium appears reasonable given its discount to its historical averages in the past. All told, we think that Acadia Healthcare is poised for strong results in coming quarters, and the stock can form one of the building blocks of a successful portfolio. It is today's one stock to buy right now. We will now tackle your questions. Please note that I typically can't answer complex questions about specific stocks on the spot. For this, I recommend a review of our latest reports. The first few were submitted prior to this presentation. And now I will hand it off to Alan and Nate. Thank you very much.
Hi, I'm Nathaniel Ekman. I'll be taking some of your questions. To start off, we had a question asking if we could recommend any good solar or other eco-friendly companies that people should be investing into. Now, as Charlie said, we can't really get into specific stocks during the Q&A here. However, I did want to take a chance to highlight that we do have an entire product, the Climate Investing Service, that is designed for investors who are interested in those sorts of stocks. It's a monthly product. It comes with a feature article discussing some piece of, green technology or law or something else that's relevant to investors in that space, as well as a model portfolio, which is updated monthly, focusing on those sorts of issues. So if that is something that interests you, I would encourage you to check that out. I am one of the analysts on that product. And I think we do a pretty good job. So.
Daniel, I see another question that came across is someone asked about if you could screen by sector, and you can absolutely do that. We for this one stock to buy right now, we start with a broad paintbrush and kind of narrow it down to the stock. That's a one stock to buy right now. So you can absolutely screen by sector. You can go into, like, for instance, you can go into, hold on one second. You can go into, say, the semiconductor industry, and you can rank them by timely stocks with a 1 or 2 for safety. You can do a financial strength of A A plus or better, so you can get, stocks that are relatively safe on a risk adjusted basis. So you can toy around with it no matter, however you want. So for this particular screen, like I said, we use these parameters, but you're welcome to use any parameters you like. Thank you.
I have a question here asking about the timeliness rank, that sometimes we will have a stock with a timeliness of 1, but the 18-month target price range might be underwhelming, and asking why that can be. And the answer to that question is that those two time frames aren't the same. The timeliness rank is measuring, year ahead relative price performance, whereas the 18-month is 18 months, right? So there can potentially be some disparities between those. Internally, we often sort of think of the timeliness as, sort of the near-term time frame, and the 18-month TPR is sort of more intermediate. And then, there's the 3 to 5 year projections, sort of the long term as the final part of that trifecta, right?
Thank you, Nate. There's also a question somebody asked about another one of our products as far as the option screener. And we have an option survey, which I'm going to click on now. And we actually have a screener, which we're not going to get into today, but I just wanted to show that also, we have a screener that's just specific to that product that, that subscribers can use. So a lot of our subscribers find that extremely helpful as well. Nate alluded to the climate change product. So we also have this options product that someone asked a question about. So I just wanted to point that out, that it does have its own screener. Thanks.
Mm-hmm. I've got a question here asking about Nvidia. Again, I can't comment on specific stocks. I can, however, talk a bit about, AI in general, that technology, because, that is sort of the thing that's been boosting Nvidia. I can speak to that. In terms of AI, it's interesting thinking about where that technology is going to go in terms of, from an investment perspective. I think the big thing to watch right now is definitely the way that IP law is going to settle, because you have a number of these big intellectual property lawsuits from, there's the New York Times lawsuit, there's the Getty Images lawsuit, where they're suing over the use of their copyrighted information in training these AIs. And that has some very profound implications for the space, because if, the courts side with the plaintiffs there, then it becomes very legally risky for these companies if they don't own all of the data that they're training these AIs on, which is going to make it a lot more expensive unless they can slim down the amount of data that is required to train and run those models. And honestly, they may need to do that anyway because of other concerns, like the availability of data, what happens when you train AI models on data that was generated by AI. And so I think that on the AI tech side, something to look for as an investor is what a company is doing in terms of not just making the model better, but more data efficient. On the side of supporting tech, like chip makers like Nvidia and others, that has less of an impact, because those companies, they're going to need the hardware no matter what. Depending on how that data efficiency process goes, they may need a bit less of it, but I don't think that's going to be a hugely significant factor for them.
Thank you, Nathaniel. There was also a question about the debt level, which for this particular company, Arcadia Healthcare, it's about 34% at the end of the September quarter, which is by and large roughly average there's not an exact figure, but in the average range, let's say, for most companies. And we absolutely look at the debt level, but I think it's on an industry by industry and sometimes company by company basis. There are some industries like amusement parks or, cruise ships that they're gonna have a higher debt level than most others. There's just a higher barriers to entry. There's the cost of production's a lot higher, things like that. Whereas other industries have very low debt levels, like insurance generally has much lower debt levels, like property casualty insurance has much lower debt levels than the standard industrial company. So we do look at that, mostly related to peers and mostly related to its historical average, but it's also how well it uses its debt to generate profits. I mean, the degree of operating leverage, all that good stuff. So we definitely take that into consideration. But in this particular instance, 34% is completely in the normal range, and they're doing a good job of generating profits from that leverage. Thank you.
I've got another AI question here. Specifically, it's asking is there any AI potential component with Acadia? And what I would actually say to that is I would be cautious of reading too much into the majority of companies trying to tout their AI potential, right? Because they know that's something that investors want. They know that's hot right now. And so you see a lot of companies, on their earnings calls trying to, hype up their AI initiatives. And then when you actually dig into it with an understanding of what the technology does, what its limitations are, how it works, it's a bit of a nothing burger. So my advice to investors would be, yes, AI is real. It's a big opportunity, but don't let talk about AI distract you from the company's, fundamentals, which are the most important thing.
Thank you. I actually saw another one to talk. Someone actually wanted me to show the screen for the sectors, and I'm just going to briefly do that. So under the screener section, you go to company data, then you click on industry, and then you could, it says select a value. You can, let's just do automotive. So you can look up, these are all the automotive stocks under our coverage. And then you could use any of the factors here like safety. Use any of the factors, you do safety of, 2 or better to see all the automotive stocks with a safety of 2 or better, and there's only 2. And you could have put other factors in there. You could do timeliness rank, technical rank, market cap. So there's once you start out with the sector, you can look into individual sectors. If you're into semiconductors or recreational stocks or insurance, what have you, and that's what you want to add to your portfolio to kind of balance it out, you can go that route as well. So thank you.
Mm-hmm. Let's see. Do you see any other questions that you think we can really hit here, Alan?
Now the only other, someone asked if there was a runner-up, so to speak, out of those 14 stocks, and that's a very good question. And we don't really have a runner-up per se, but when we do these screens, we the 3 of us as well as other parts of our members of our team have a discussion about what stock we think is the best to choose based on these screening criteria, and it's not a decision we take lightly. So out of those 14, yeah, we do narrow it down. I don't know if there's a runner-up per se, but we usually get the list down to maybe 3 or 4, and then choose one from that group. Based on what we all think about those particular stocks. So that's a great question, but we don't really have a runner-up per se. But I just want to address that. Thank you.
Mm-hmm. All right. I think that's probably our questions for today.
Yeah, thank you. We'll hand it back to Tim. Thank you all for joining us.
Yeah, thank you for joining us.
Webinar attendees, thank you for attending today's webinar. We do appreciate your attendance.